And how are you, Roger?
It's interesting. Since October, the industrials index is down about 7%, but good quality stocks are down a lot more.
Are they?
Here's an interesting thing. Credit Suisse put out a research note last week, and they talk about style of investing. So you got value style, you got your quality style, you got growth, you know, all those momentum, all the different investment styles. The worst performing style in the United States summer for 2013, so June, July, August, was quality. So they suggested...
How do you define quality?
Well, I don't know how they do it. Well, I think we're going to have a great day today. Cause
working out what quality is.
He's going to work out what quality is. It's got nothing to do with share price. And so what they said was that what you should do is switch out of quality and go into lower quality companies with good momentum, because the economy's going well now. People are throwing caution to the wind, and it's time now, you know, to put the horns up and go for it. But that's ridiculous.
Clearly. I was listening to a Bloomberg web thing, you know, this week, and they were saying that all the letters, you know, so a guy will write a letter as an advice, and he'd say, look, you know, follow my letter, I'm an expert in markets. You know, you've got a blog, but it's in the States, they're so professional with those letters, and people pay for it to get their advice. It's the first time in 10 or 15 years that they're all saying buy equities. Everyone is saying buy equities. And of course, you know, you can just hear the little bell ringing. Correct.
And in fact, we divide up the market we credit score every listed company in the world, and we do it for Australia. And in Australia, we take them from A1 down to C5. C5 being the highest risk of collapse. So Guns was a C5, Hasty Group was a C5, Becton down in Melbourne, C5. Qantas is below investment grade as well, so is Virgin for that matter. And then the A1 companies, you know, very high quality CBAs and A1, there's a few others, but a lot of big companies you think that would be aren't. The A1s, the median excess return of an A1 stock since July 1, minus 23%.
Wow. And what are you saying? It's because they're all trying to get into...
People have said... They're sold the good stuff.
Out.
They're rotating out of the good stuff, and they're getting into companies because they ran hard and they ran early. And what they're doing now is they're getting into businesses that are arguably lesser quality but cyclical. Boral, Leighton's, Lendlease, those sort of businesses.
We have our first email for the night, which is a good one for what you were just talking about.
I thought you were about to say we're going to an ad.
No, they do that later. They do that because
that's important.
It's well,
it is.
That's important.
Not to us.
Not for viewers or us.
It interrupts a very good conversation. The All Ordinaries, if we can just take this first one, it's from Tom. The All Ordinaries is still a long way from its 2007 high, and yet most people think it's overvalued. I'll just get my thing to work.
Which is what you and I were just talking about.
That's right. We don't have a housing crisis like the US and Europe, so why is the earnings growth of most large Australian companies so terrible? Thanks, Tom.
Two parts to that.
Yep.
Part one, just because the All Ordinaries isn't at a previous high doesn't mean it's expensive or not expensive. It's got nothing to do with where it was. It's all about what's in it today. And based on the constituents of the index today, a lot of those businesses, for example, the ones I've listed already, Qantas, Virgin, Boral, Lendlease, National Australia Bank, haven't added any economic value for a decade. BHP is going to earn the same profit in 2014 that it earned in 2006 with 3 times as much debt.
Wow.
Right? So they're not adding economic value, and so they're constituents in the index, and so the index doesn't go up because price follows value.
We are 4th biggest superannuation fund in the world. The previous government, there was been some talk around the politicians looking at it as a tax opportunity, and there was a complete furore. How do you perceive this evolving, you know, this swelling of money?
I have a big concern. Look, I'll tell you what my concern is. My concern is that it's a structure that was developed by baby boomers, for baby boomers. When the baby boomers are done with it, those of us who are left with it, we're going to have to work until we're 80 to get it, and we won't get very much, and we won't be able to take it out as a lump sum. Because the interest of those who created it, they're no longer interested in it. So that's my big concern. I wrote a bit of a rant about that last year or earlier this year, just saying that if you're under 40 today, you want to minimise your contributions to super, not maximise them. You want to put an absolute minimum in that you're allowed to, simply because, one, you're not going to see it for a very long time, and two, you may not ever see it.
Because you're feeling that the government will take it.
I think because of the generational avalanche that we've got, it's clear, and all the studies support it, that we can't afford the healthcare costs. The government can't afford the healthcare costs under the present model. There'll be a transition, a long transition, where they won't be able to afford it. And so I think it'll be too tempting not to dip into it.
What are your... if that's one of your fears, what are your other fears?
It's just a personal opinion, mind you. It's not a forecast.
Absolutely. In terms of... we're talking about fears. What is your fear at the moment about today? You know, that the 40-year-old and self-managed super fund, I get. But in terms of the investment climate right now, it feels, and I'm shifting gears here a little bit, but the equity market feels it's soft. You know, it feels over the last couple of weeks have been fully stretched.
Okay, my biggest concern...
What's your biggest concern in terms of the investment school?
My biggest concern of all is that, you know, you've heard lots of people talking about bubbles.
Yep.
Bubbles in stocks, bubbles in property. We're nowhere near a bubble in either of those asset classes. It's nothing like a bubble. We don't have the main ingredients. They haven't germinated yet.
Yep.
But Janet Yellen and Christine Romer could be taking Janet Yellen's vice chair position at the Fed, and Janet Yellen the Fed chair. They have made several statements in speeches that they've given and papers that they've submitted to say that the current people in charge of the Fed, the current board of the Fed, are, quote, irrationally fearful of bubbles.
Yep.
And they're more concerned about bubbles than GDP growth. And what she is talking about when she says that, I believe, is a regime shift where the Fed no longer focuses on inflation but starts focusing on GDP. In other words, if she takes the helm and Christine Romer takes the vice chair position, you will see them plant their foot on that accelerator, and it will get potentially even worse because they aren't going to lift the foot up as soon as they see inflation. They'll keep the foot down until they're sure everyone's employed and GDP growth is strong and stable.
I agree.
And that's dangerous. Very, very dangerous. Then you'll see a bubble.
They're definitely doing that. I'll tell you what. The demand for dividends. Everyone wants these dividends. So Rio and BHP is now a dividend play. That's crazy. And so what it's doing is changing the way companies act.
Okay,
the shareholders
the government can compensate for that. You know what the government can do? The government can say, well, as Kevin mentioned earlier, the government's not historically very, very good at allocating capital and choosing industries to support, right? But the market is, and that's what the market's good at. So what you do is you say, right, every startup business, and it can't be Woolworths Linfield Proprietary Limited, that's not a startup business, right? But a true startup business, go out and employ people. You've got a tax holiday. This is just an idea. You've got a tax holiday for 3 years, first $300,000 profit, tax-free. Let the market determine what Australia's good at. And then the government can come in and say, we're going to support that. Clearly, that's a strength of ours. We're going to encourage that. We're going to provide grants to that. That's going to be our focus. That's what we're going to be good at. We export that. We fix our balance of payments, current account deficit.
We have one more ad. And then